Investing in managed funds is one of the most popular ways to diversify your portfolio and gain exposure to markets, sectors, and regions that may be difficult to access through direct share ownership. With thousands of managed funds available globally, identifying the best ones can feel overwhelming. However, by following a systematic two-step process that combines qualitative and quantitative analysis, you can confidently select the best managed funds for your portfolio. This guide will walk you through the updated process of finding the best managed funds in 2025, including a practical example of using the Morningstar Investment Screener. We'll also explore how Australian investors can access Morningstar's tools and compare the Australian and US Morningstar platforms. Hi, and welcome to the Retire Well project. As a retired financial advisor, my aim is to make sure people understand investments inside and outside of superannuation to maximize their retirement benefits. While financial advisors have access to much more sophisticated research tools, this guide will show you how to achieve similar results yourself without using the services of a financial advisor. While this guide is predominantly for finding the best managed funds outside of super, it can also be used for those wanting exposure to managed funds inside of a self-managed super fund. If you are using an industry or retail superannuation fund platform, then you will be limited to the managed fund options available within the platform. But the same process that I am about to explain can be applied to the available managed funds within your platform to find the best funds for your purpose. Let's get into the process of finding the best managed funds. Step 1. The qualitative approach. Finding the best fund managers. The first step in choosing the best managed funds is to assess the quality of the fund managers. This involves qualitative analysis, which evaluates the expertise, experience, and investment philosophy of the fund managers, as well as the robustness of their risk management processes. A skilled and experienced fund manager is critical to consistent, long-term performance. Even the best performing funds can falter under poor management or a lack of a disciplined investment strategy. Look for fund managers who have a strong and proven track record, follow a clear and transparent investment process, exhibit effective risk management practices. Independent research houses such as Morningstar, Lonsec, and Zenith are widely used by financial advisors to assess fund managers. These research houses evaluate funds based on the skills and experience of the investment team, the consistency and transparency of the investment process, risk management frameworks, and governance. Morningstar uses a fund analyst rating system to assess the quality of managed funds. Funds are rated gold, silver, bronze, neutral, or negative. Gold represents the highest quality. As a rule of thumb, focus only on funds with a gold or silver rating when building your portfolio. These ratings are based on a combination of qualitative factors. Step 2. The quantitative approach. Finding the best performing funds. Once you've identified high-quality funds, the next step is to evaluate their performance. This involves quantitative analysis, which looks at the fund's historical performance across different timeframes. While past performance is not a guarantee of future success, it provides valuable insights into how a fund has performed under various market conditions. Consistent performance over time is often an indicator of a well-managed fund with a sound investment strategy. Morningstar's Investment Screener is a powerful tool that helps investors filter and compare funds based on specific criteria. This tool allows you to rank funds within categories such as Australian equities, international shares, or sector-specific funds. It also provides performance data over multiple timeframes, including 3 months, 6 months, 1 year, 3 years, 5 years, and 10 years. For the purpose of selecting the best performing funds, focus on 3-year performance. This should be the minimum time frame as it balances short-term market volatility with long-term changes in fund management or strategy. By sorting the data by 3-year performance, you can now see the best performing funds with the best quality ratings. Let's walk through an example of how to use the Morningstar Investment Screener to find a high-quality and high-performing Australian equity fund. Visit the Morningstar Australia website, morningstar.com.au. Log in to your account. If you don't have one, you can sign up for a free 1-month trial. Note: US-based investors can access the Morningstar US website, morningstar.com, with a 7-day free trial followed by a paid subscription. The US platform offers access to a broader range of mutual funds compared to the Australian site. Open the Investment Screener tool. Apply the following filters. Morningstar rating. Select funds with a gold or silver rating. Category. Choose Australian equity to focus on funds investing in Australian shares. Performance timeframe. Set the performance metric to 3 years. Review the list of funds that meet your criteria. Look for funds that are ranked in the first or second quartile for 3-year performance. By that, I mean look at the best and worst performing funds. In this example, we are looking at 15.08% as the best. The worst fund is showing a negative return of 12.11%, but let's discard this one as it seems well outside the others at the low end of the scale. We will take the next one at negative 1.41% as the worst performing for this example. The halfway point is therefore approximately 8.5%. So all funds with a return above 8.5% are ranked in the first and second quartiles, and these are the ones you should concentrate on. Open the detailed profile of each fund to review. From here, you can review each fund in detail, including the investment strategy used to see if it aligns with your goals like large-cap Australian shares or small-cap growth stocks. You can also assess the fees and minimum investment. One thing to note here is that if the minimum investment is around $1,000, then you are looking at a retail fund which typically has higher fees because they have more accounts to manage. If the minimum investment is $20,000 or more, then you are likely looking at a wholesale fund, and these typically have lower fees because they have less accounts to manage. Use the comparison tool to identify the best option. Let's say the screener identifies the following 2 funds. Fund A, a gold star rated Australian equity fund ranked in the first quartile for 3-year performance. Fund B, a 4-star rated Australian equity fund ranked in the second quartile for 3-year performance. In this case, you might prioritise Fund A for its higher rating and top-tier performance. However, Fund B could still be a strong contender if it has lower fees or aligns better with your investment strategy. Additional considerations for Australian investors. There are thousands of managed funds available outside of superannuation in Australia. This gives investors ample opportunities to diversify across asset classes like Australian equities, international equities, fixed income, and alternatives. Sectors like technology, healthcare, resources, etc. And regions like Asia Pacific, US, Europe, and emerging markets. Environmental, social, and governance. ESG investing continues to grow in popularity. Many managed funds now incorporate ESG criteria into their investment process. If responsible investing is important to you, look for funds with a strong ESG focus. If you're investing through superannuation, ensure that the funds you select are available within your super platform. Many platforms offer curated lists of managed funds, making it easier to apply the qualitative and quantitative approach. Managed funds come with management fees, which can impact your returns over time. When comparing funds, pay close attention to the management expense ratio, MER, and any additional fees. Opt for funds with competitive fees relative to their performance and quality. Building a portfolio of managed funds is not a one-time exercise. Markets and fund managers change over time, so it's important to review your portfolio annually. During your review, verify that each fund still has a gold or silver rating. Check that the fund remains in the first or second quartile for 3-year performance. Replace any underperforming funds with better options. This disciplined approach will help you maintain a high-quality and high-performing portfolio. Investing in managed funds allows you to leverage the expertise of professional fund managers while diversifying your portfolio across asset classes, sectors, and regions. By following the two-step process outlined in this guide, you can confidently select funds that are both high quality and high performing. Step 1. Use the Morningstar Investment Screener to select funds with a gold or silver rating. Step 2. From your selection of high-quality funds, choose only those ranked in the first or second quartile for 3-year performance. This approach not only simplifies the process of fund selection, but also provides a framework for ongoing portfolio management. Whether you're a seasoned investor or just starting out, this method will help you build a portfolio that aligns with your financial goals. If you enjoyed this video, please subscribe to our channel to access our other videos on superannuation and retirement planning. If you have any comments, please leave them in the description below. Thanks for watching.